that structure. We're starting off with a daily chart of the NASDAQ composite, and I just want to review some of the concepts I've talked about, the concepts over the past several videos. We're in a strong uptrend. This is one of those 2 to 3 times a year the market's healthy. For those of you who know my philosophy, and hopefully you've watched the educational videos and you've heard me say this 100 times, I do believe the market gives us opportunities 2 to 3 times a year, these sort of 4 to 12 week periods. It's not an exact science, but these nice uptrends where you can take advantage of stocks, where breakouts are working, minimal drawdowns, minimal volatility, and the market offers these opportunities. One of them was last year after those follow-through days in early April until about mid to late August. Then we corrected here and came out of this correction with another strong uptrend after the presidential election last year from mid-November until about early February of this year. And then I talked about this so many times that now when I reset the lines, the NASDAQ was in a correction. Growth was in a correction. A lot of the leaders from last year were in a correction, but I talked about towards early to mid-June that we were building this base, and that was anticipating us coming out of this correction. I even wrote an article for Yahoo Finance, mentioned it several times. Why did I think this was going to happen? Because 1, the technicals were setting up that way. 2, because of the historical precedents that I've talked about in previous videos. 3, because it was getting towards mid to end of June. Seasonally, that's what I'm here to remind you of. This isn't an O'Neill thing or a Livermore thing. These are just seasonal times that help increase your probabilities as we start to head out of the June quarter. You can start to anticipate earnings season. There's a lot of buy the rumor, sell the news, or run up in anticipation of earnings, of shareholder reports, of shareholder meetings, of Apple events, whatever they are, analyst meetings. There's a lot of running up ahead of that, and the market tends to do that into the next earnings season. Also, you have beginning of the month, beginning of the quarter, new money flows in, 401k money on the first and 15th. That tends to flow into the markets. That's why they call them mutual fund Mondays, when money has to be put to work on those Mondays. So nevertheless, I digress. We broke out of this range and we've been in a strong uptrend. And this is one of those times to take advantage of it. Now, I'm also here to remind you, during these uptrends, they don't go straight up. We're here. It's normal to expect regular pullbacks, especially to that 21-day moving average. During this healthy time last year, you can see several times we ran up. We held this green line, which is the 21-day moving average. Sometimes you correct through time, not through price, meaning you go sideways through time and let the 21-day catch up to it. Then you run up, and then you tend to correct down to those levels. Then when we corrected, the same thing happened here where we ran up, catch up to that 21-day. But that 21-day is a good guide, meaning in strong uptrends, strong stocks, strong ETFs, strong indexes tend to hold that 21-day moving average, the exponential moving average, a 21 EMA. Now, when we started to get a little bit extended, I'm here to remind you when we do get a little extended from the averages, when you see that daylight, that space in between the index and the 21-day, I'm here to remind you, just say, hey, it's more of a heads up. We could expect a pullback here. As I mentioned, it's not to scare members. It's not to make you feel like you have to be forced to do something. If you're not a trader, oh my God, we're going to get a pullback. What do we do? I'm just here to remind you that it's probably coming because the probabilities are showing us we're due for a pullback based on some statistics and based on just when we normally get extended. Again, I'm here to promote calm, confident traders. And I'm also want to stress the 2 things I talk about so many times, which is time frame and entry point. Meaning, if you have, there are some members that are relaxed, have a longer term time frame. And if you got into some stocks around this 14,000, 14,200 level, when we were consolidating here, when there were a lot of setups, if you got in at that level and you have a nice cushion, then just sit tight and relax and expect that we're going to have some normal pullbacks along the way. So that's what I mean by knowing your time frame. But the key is to get those strong entry points so you have that cushion and you can be relaxed So you don't panic like all these amateurs do and people on Twitter who are just drama queens, and we gap down and they start freaking out. Shut out the noise. And I'm here to remind you to remain calm. It's not just to remind you of that, it's because it's fact. And this is normal to pull back to the 21 day. The other option is if you're a trader. So I trade fairly active. There are some traders, some members that I know are machine gun like, very, very active traders. Nothing wrong with that. They know their time frame. And I'm just here to remind you, if you're a trader and we're getting a little extended, nothing wrong with raising a little cash, taking some profits. So that way, when we do drop, you have cash to put to work during logical support levels. So, but overall, I'm just trying to help you understand some of the price action. If you take a step back, I've said a million times, keep it simple. We're in a good uptrend. Don't argue with it. The Fed's on our side. It's seasonally a strong time. The institutions, things are acting well. Sentiment's kind of muted. So stick with the uptrend. Now, what I do like about Thursday's drop here, last Thursday, is four things. We held that 21 day, again, showing that, you know, during these uptrends, it's nice to see it hold the 21 day. When we break below the 21 day, that could mean that we're due for maybe a bigger correction. The same thing happened back here, September, early September. That could just mean we're due for a bigger correction. So number one, it's good that we held the 21 day. Number two, it was on lighter volume than the previous day. So it was on lighter volume Thursday than the previous day. Hopefully you're watching the educational videos and the language makes sense that it's not a distribution day. Nice to see that the institutions are not heavily selling stock. You can also tell because we came back to close in the upper end of the range. So when we close in the upper half or upper 2/3 of the range, that's showing institutional support. Number three, beneath the surface, tons of leaders were acting great. Amazon was green. A lot of software names were green. A lot of things were acting well that by 2 hours into the session, if you just looked at a group of leadership stocks, you never would have known the Dow was down 500, the NASDAQ was down over 100 points. You never would have known that because the price action of stocks was strong. Number four is sentiment. I use sentiment as a secondary measure, and I like that there was a lot of people rushing for the exits, raising cash, shorting the market, selling stocks, rushing into puts, which I showed you in that equity put to call rating ratio. I just love that. I love that everybody's skittish. Everyone's like crash any day now, 1 foot out the door. That mentality is what's going to keep things going higher. I love that any little drop, people rush for the exits. That's why I'm trying to encourage you. Don't be like everybody else, especially when everyone's scared. Remain calm, get those strong entry points, have some conviction in what you're doing. I will say this, though. In early October of 2018, let me show you this really quick because you brought it up, Joe, so you might as well show us. This is 2018, right around in here when Fed Chair Powell, just to give you perspective, 2018. When Fed Chair Powell, that's an 8 that I'm trying to draw. Anyways, when Fed Chair Powell says, I'm going to raise rates 3 or 4 times over the next year, the market's like, oh no, we can't handle that. We got to de-lever here. We can't handle this much, this many rate hikes. So what happened was we decisively broke through the 50-day. There was no fear whatsoever. And then we were down to the 200-day. And I was like, is anyone buying puts here? Is anybody raising any sort of cash? It was incredible complacency. And ironically, we didn't have a high put to call reading until literally December 21st of 2018. In other words, the market kept sliding until people actually stopped getting complacent and a little fear crept into the market. So my point is, as long as we drop and that fear comes in, then stick with the trend. When we drop and everyone jumps out, everyone is complacent and people are like, oh, I'm going to buy this dip, and everyone's complacent, that's when I'll get a little bit worried. When that time comes, I will hopefully spot it and explain it to you based on my interpretation. Now, before I get into some stocks, I talked about this. We're in a strong uptrend. How do you take advantage of it? 3 ways: ETFs, individual stocks, or a blend of the two. And what you decide is totally dependent on your risk tolerance, depending on your investment objectives. Some members are investment advisors, run hedge funds, that they're more into ETFs for their clients. That's fine. Do whatever works for you. For example, when I talk about the mega caps, Amazon, Apple, Microsoft, a lot of those stocks acting well, and you say Adobe, a lot of these names acting well, and you say to yourself, well, I'm not sure which one to buy. Nothing wrong with jumping into the QQQ to give you broad exposure to a lot of those NASDAQ 100 top tech stocks. If there's a lot of energy names setting up, you want to grab the XLE or OIH. That's what I mean by you can use ETFs to give you broad exposure. If you want to jump into individual stocks, then two questions come up. How many do I buy and which ones do I buy? The first question is, how many do I buy? I discussed this in the educational videos. There's no right or wrong answer. I prefer a concentrated group of stocks because William O'Neill talks about 20 stocks as perfect diversification, and he's one of the best out there. So I'm going to trust. And I also kind of believe that because it's also, I've noticed that myself, and it also becomes too many stocks to follow once you get over 20. However, there's some members who told me they literally have stomachs of steel. They own 4 stocks, 25% positions. God bless. They know their risk tolerance. They're super concentrated. They know what they're doing. They're okay with volatility. They've defined themselves. There are other members who say, I own 10 stocks, 10% positions. And that's also aggressive, but that's great. They know what they're doing. When I manage money for clients, I can't be too super concentrated. So I think about 15 to 20 stocks, sometimes with some cash also helps. There are other members that are fairly new, that don't have crazy risk tolerance, and they own 30 to 50 stocks, roughly 1 to 3% positions. There's nothing wrong with that. As I always say, do what works for you. And I just think once you get into more than 50 stocks, try to avoid FOMO, fear of missing out. Try to avoid you have to own everything. Just try to keep it relatively concentrated. Now, if you own a blend of ETFs and stocks, then for sure you want to have less stocks, maybe a little bit more ETFs to participate in the broad indexes going up, and then keep your number of stocks low. But just try to avoid the feeling of wanting to own everything. I'm just trying to help and remind you that FOMO is for the weak. Don't be weak. Now, the first question is, how many do you own? Again, there's no black or white answer. There's a lot of gray area. I leave it up to the members to make decisions. I can give you guidelines, but ultimately you make these decisions based on what works for you and your own risk tolerance. Now, the second question is which stocks to own. I prefer growth names. As I said, I have 2 objectives. I have a million objectives with this product, but one of them is to keep you on the right side of the market, which I think I've done a really good job of. And then 2 is when the market's healthy, I'm going to try to expose you to some of the stronger stocks. I've talked about semiconductors, software, some of the mega caps coming to life again over the past few weeks. Software, semis, medical products, some energy, and mega caps. Now, I will say this, and I'll get to some stocks in a second here, is just understand, accept you can't own everything. You just have to make decisions. As they say, make your bed and lay in it. It's okay. You can't own everything. I sold some medical product names to rotate into some software names. And I'll give you an example because I do give you, as best as I can, exposure and visibility and transparency what I'm doing. I talked about selling a few medical product names a couple weeks ago. About a week or 2 ago, sold InMode somewhere, I don't know exactly, I forget, 95, 93. It's okay. It dropped down last week down to the 50-day, snapped back, and they guidance pre-market today, guided higher, and it gapped higher. Now, a couple of things. First of all, I mentioned this stock several times and had a pretty aggressive position in the 40s, did very well on it, so it's okay. And the second thing I want to pass along from experience is, to be honest, 15 years ago, 10, 12, 15 years ago, I would have been steaming that I sold something a week ago that gapped up. Now, the more I do this, it literally doesn't even pinch me. I literally don't care. And I don't say I don't care like I missed out. I didn't have a big position, and I make decisions because you know what? I've also sold some things that have gone considerably lower. So you take the good with the bad, except you can't own everything. I am just here for idea generation, and I want you to make decisions. Some members don't like medical products. Some don't like biotech. Some don't like the mega caps because they're too high priced, $2,000, $3,000 a share in the case of Google and Amazon. It's okay. I'm here to present a decent group of stocks because at least, and I even tweeted it out, and I've said this a million times, when William O'Neill talks about a lot of people fail because they buy garbage stocks, I'm here to present you with at least a strong group of stocks to at least give you a chance of stocks that fit the blueprint of the biggest winners throughout history. And it's up to you to decide and just accept. You might miss some, you might get stopped out, some might turn around. It's okay. Just again, trying to remain calm, confident traders and just accept things will go without you. You also might take profits and things will go higher. It's okay. I'm not trying to encourage people to be complacent. I'm just encouraging people to reduce their emotions. And I'll perfectly admit that years and years ago, I would have thrown a monitor out the window if I sold something that gapped up a couple days later. And these were big monitors back then too. They're not the flat screens like they have now. Anyways, I'm kidding, not really. But my point is, the more you do this, it's okay. You just have to learn to let things go. Now, I'm going to get into some stocks